This is DBrief, brought to you by the Australian Industry Group.
Welcome to DBrief, the podcast where we explain policy to industry and industry to policymakers. I'm Jeff Wilson, and today I'm hosting on behalf of Louise McGrath, who you'd normally hear in this chair. And in today's episode, I'm really pleased to be joined by Innes Willox, Chief Executive of the Australian Industry Group, because we're going to be talking all things tax and tax reform. About a month ago, the federal budget was released, and it contained a wide and complex array of tax changes that are going to impact on business. In the months since, it's been an extremely hot topic on the national agenda, with intense debate about where the tax system is heading next. So today, we thought it'd be a good time to unpack one key part of that conversation in a bit more detail: capital gains tax, and what these current tax settings mean for business, investment, and the wider economy. Innes, great to have you with us.
Thanks, Jeff. Great to be here.
Well, Innes, about a month ago, you and I attended the budget lockup together. And as we widely expected, it was a tax reform budget this year. Probably the first since Peter Costello's final budget, which was now 19 years ago. So after a lot of abortive starts, an Australian government has finally grasped the nettle of tax reform. While the big ticket changes to things like capital gains and trusts have consumed public attention, and we will talk about those in a moment, there was actually quite a lot of tax reform in the budget, and in places much to like. Putting aside the CGT stuff for a moment, how does industry think about these forgotten parts of the 2026 budget?
Well, Jeff, I think that's a really important point that you've made. The budget discussion since May the 12th has been completely subsumed, overwhelmed by the conversations around capital gains tax changes, and they are important, what has been proposed. But underneath all of that in the budget were a range of really quite positive measures for business. And we made that point on budget night, that there was a lot here that would have been liked. If you'd put the capital gains tax aside, business would have been really pretty pleased with this budget because of some of the measures that had been put forward that really went a long way to what we had asked for and sought on behalf of the business community to simplify their life when it came to operating a business. And you think about things like the introduction of 2-year loss carryback and permanent instant asset write-off, two really important measures which would help business navigate what are very tricky economic times. And it has to be remembered this budget was framed, a month ago at the then height of the US-Iran conflict and the closure of the Strait of Hormuz, and a great deal of uncertainty that was created at that point and continues to this day. But a lot of that uncertainty was leading to concerns from business about, the state of their business and their ability to carry on, to absorb losses, to make investments. And those two measures, instant in 2-year loss carryback and instant asset write-off being made permanent, both of them were really positive and were welcomed and continue to be welcomed. You had simplified deduction rules for individual taxpayers, again, an important change, not a business benefit as it were, but it also was a common sense measure the government put in place, which has a community benefit. If it has a community benefit, therefore it does, by extension, have a business benefit. The government started down the road of changes to the R&D tax system, which came out of a review which ran through most of 2025 and into consideration in early 26. We thought that directionally that was going in towards the right place. It was a mixed bag in it. Some we liked, some we didn't like, but the fact that the government was tackling R&D tax reform is really important and shouldn't be discounted or diminished in any way. And that was a real positive from the budget. And the final one I'd point to is a whole bunch of regulatory reforms that the government made, which came out in large part out of the Economic Roundtable, which I attended last August on behalf of industry. And we put forward a lot of proposals which the government pleasingly picked up out of that reform roundtable that we put forward to make life easier for business in a regulatory sense. So think about expedited environmental approvals, very important measure. free standards, the expansion of the trusted trader system so that if a business proves itself to be a reliable trading partner, it sort of gets to cut through the thickets of red tape which impact their exporting and importing abilities, all very important. And there were a lot of good measures there for business. So were it not for these tax changes, which has had everyone shouting from the rooftops, we'd have seen this as overall a pretty positive budget. But we do have those tax changes, and that's what we're here to talk about today.
Thanks, Innes. And look, as you said, one of the problems is all of that good stuff has been overshadowed by the government's proposed changes to capital gains tax and discretionary trusts. The changes are exceedingly complex, and I'm not a tax accountant, so don't take this as tax advice. But to just give you a brief outline of what's happening at the top level. First, we've had a change to the system for how inflation adjustment is done to capital gains tax. And we're moving from a flat 50% discount to a complex inflation-based indexation system. Negative gearing for existing but not new build investment properties has been removed. And we've also introduced a 30% minimum tax on all capital gains and a 30% minimum tax on distributions from discretionary trusts. Now, that's very complex, and while those changes together is going to have different impacts based on the taxpayer's individual circumstances, for the majority of taxpayers, this is going to raise the effective tax rate on their investment income. And for some businesses like startups that start from a zero capital base, that's going to raise their tax by a very considerable amount. With the exception of the negative gearing changes, these changes also apply prospectively. So they're going to apply to existing assets that were purchased in past years, even before the start date. But before we go into this too much further, Innes, I'd just like to start with a context, and which is, where did all these complex CGT changes come from? The Treasurer declared an intent to pursue tax reform in a big speech to the Press Club about a year ago. And as you mentioned, this was discussed quite at length in the economic reform table you attended last August. But capital gains wasn't really part of the tax debate until just a couple of weeks before the budget. So why has this rabbit suddenly been pulled out of the tax reform hat?
It's a really good question, and it came as a surprise, I think, to everyone who went or attended the economic reform roundtable. It was not discussed in any remote way in the form that it has been produced in the time since the economic reform roundtable met last August. There was quite a detailed conversation around tax. So the reform roundtable was a 3-day event, and tax was probably the central part of the conversation. But the conversation went in 3 parts. One was around how taxation on assets and income should look going forward. There was an agreement or an understanding that the differential between the two, income and assets, was too great. It was creating distortions in the broader economy and needed to be looked at. I'm talking about assets there, and the number one asset that people hold is housing. And that's where the conversation really went in the round table, was looking at housing. A lot of the tax debate was focused on the conversation around, well, how do we improve the housing stock overall, point one, and point two, what is there that we can do as a country to help younger people get into the housing market? Because there's a view widely accepted that, things had got out of whack. It was now getting beyond many young people to enter the housing market, certainly at an age where people 20, 30, 40 years ago were able to. So their entry into the housing market was much delayed. And then that was having broader consequences through the economy, demographic change, spending change. All of those sort of things were being impacted by this. So how could we look to address this imbalance? That wasn't to say that assets and income should be taxed identically, but how do you sort of tip the scales a bit? But again, I stress it was all about housing. That was what this conversation was based on. And it was also then tied into a wider conversation, which perhaps we might want to get into later, which was around how corporate tax and income personal tax were also treated. But the the fact that, this came from literally nowhere, I think surprised everyone. It surprised us because there wasn't really any consultation of note from the government around this. There was a lot of speculation around the rate that maybe the capital gains tax would be imposed upon business. Upon the community, particularly looking at households. But there was no sense that it was going to be applied more broadly into business. So the fact that when it did come out on budget night the way it did took everyone aback. It hadn't been, to our mind, properly tested, consulted upon or thought through. It hadn't been road tested to see what the implications would be, particularly for investment. And I'm sure we'll talk about this in a minute, Jeff. It's sort of gone well beyond what was its original remit, and it's something that we fear will have potentially really quite dire consequences for the economy as a whole should it be implemented. Now, Jenny Wilkinson, the head of Treasury, has said, well, revenue needed to come from somewhere. That was a quote, revenue needs to come from somewhere. That's quite alarming because this is not just a revenue equation. It's also a spending equation that needs to be taken account here. What do governments spend on and how do they spend on it? It's just shouldn't just be about raking up revenue. It's about allocation of resources, and that seems to have been missed here. The other point is we're really alarmed about how quickly this has worked through. The budget was May 12. We're a month or so beyond that now. It's not a lot of time to give what is a complex measure real consideration around its intention and impact and reaction, to gather reaction. So it's come out of nowhere and we think it's being rushed through the parliament or sought to be rushed through the parliament in a quite unseemly manner, to be honest. We have a Senate committee hearing, which the government gave no indication they wanted, but it's going to sit for 2 days. The fear is that it will be perfunctory at best and will have a major measure imposed on the community, far broader remit than originally intended, but with quite devastating consequences for the economy, particularly around investment aspiration and risk-taking.
Thanks, Innes. Now, there's been an extremely strong and negative response to these changes, particularly this capital gains tax indexing from the business community. Our current CGT arrangements in Australia have been in place and unchanged for 27 years, which has proved critical in providing the policy stability needed to attract and retain long-term investments. Now, of course, different parts of industry have different objections. There are some issues facing startups, issues facing small business, issues for higher risk innovation investments, and issues for investments in large fixed assets and more besides. But now that we've spent a month talking with industry about this and how it's going to affect the complexion of their specific business, what's the overall nature of the problem here?
Well, Jeff, I've made it really clear in public commentary, and I'll reiterate it here. There's a lot of what I would describe as white-hot anger out there among business leaders, business operators and owners at what is being proposed. And the anger comes from many different reasons, and I'll run through some in a second. But the unexpected nature of what has been proposed has caused consternation. The uncertainty that it is creating in the marketplace at the moment is causing consternation. This is going to have a really damaging impact on investment. It is very clear from talking to businesses. Businesses are making it clear that they will either not make investments that they were planning on doing, will substantially alter those investments to lessen the damage, or they will take those investments offshore. To say or to think that to change the taxation regime around investments would have no impact on investing is, it is really sort of wild to think that. It makes no sense. And I talk to people overseas about it. I mean, I get calls from people overseas about it, and they are sort of dumbstruck by what is being proposed here and the seeming lack of understanding among policymakers at the impact of what they are proposing here. Again, it goes to not having thought through exactly what they are putting forward. So, look, if I want to take it down into sort of particular areas, Jeff, I'd say there are five that I'd point to, areas of real concern. One is that this tax proposal is retrospective. It's retrospective in action and it's retrospective in nature. It will apply to all assets, not just those purchased from the operating date of the 1st of July 2027. So it goes backwards in time. It applies retrospectively, and we can't get away from that. There's no grandfathering here. Existing investors who committed to an investment on the basis of the simple current regime, what we'll call the 1999 regime or something close to the 1999 regime, now face a very new and very complex set of rules, which in most cases will significantly raise their tax bills. So investors had made investments in good faith. Now the rules have been changed on them and are being changed on them by this measure. So 1, retrospective. 2, is very clearly biased against risk-taking, and that's why you've heard the hue and cry from the startup sector. But it's not just the startup sector who are impacted here. It's business across the board, no matter their size or sector or shape. It will have a very deleterious impact on both aspiration and risk-taking. What is of real concern is that gains are going to be treated more favourably than losses, and that will make higher risk investments. If your business is prepared to take more risk, the penalty for getting it wrong will be greater. Those higher risk investments are the ones that are going to drive productivity in this country. And if you're being penalised for taking risk and for driving productivity, that is very clearly not a good thing. And it's also going to make making a loss less attractive, make taking risk less attractive. Big problem on that front. Why would you take a bigger risk if you're going to be punished? It leads to an outcome of mediocrity and non-risk taking. The minimum tax rate is punitive. You pay 30% on capital gains or on trust distributions, irrespective of your marginal tax rate. And this creates a bizarre situation, a perverse situation where capital gains can be taxed higher than other income, simply because they are what they are described as capital gains. They will be taxed higher than other income. Now, you remember I talked about earlier on about trying to get a better balance between assets and income, but now you have the situation where capital gains are going to be charged higher than income. It makes no sense whatsoever. So it's a reason to avoid capital gains if you can. The fourth reason is there's no income averaging. So, businesses earn capital over many years. It's not just a one and done situation. Capital from investment is earned over many years, and sometimes that goes into decades. It's not just a 1 year situation, to repeat that. And the pre-1999 situation, allowed for, it was an indexation system, and it let you spread, that system then let you spread a capital gain over 5 tax years. Let you spread it over 5 tax years. The current system that is being proposed by the government does not do that, and it forces gains into a single tax year that will attract an enormous tax bill. So you can't smooth it out. You can't smooth out your capital gain. You're going to get hit in 1 year, which is going to create a perverse situation and astronomical tax bills in many cases. And this is particularly penalising to startups, who are already indicating to us, there's going to be a flood of startups just taking off and heading off overseas should this go into place. And the final point I'd make is that, again, we're getting into an argument with government around how do you define a small business. Small businesses are exempt from these changes, but the level at which a small business is defined as being a small business is particularly small. It's micro businesses. Their turnover has to be under $2 million or assets under $6 million. They're very small businesses. And it's a disincentive to grow from being a business of that size to something larger. Those numbers, the turnover of 2 million or the assets under 6 million as part of the small business definition, haven't been altered or indexed for about 2 decades. So we're dealing with really small numbers here, and they're too low to recognise even the scale of what would be regarded as genuinely as small businesses in the Australian context. As I said, they're micro businesses. So even small businesses that are doing, quite well, employing, a reasonable number of people, a good handful of people, they're going to be penalised in a big way here too. So you've got to look at those, the markers that we set for small, what is a small business in Australia? They're not small businesses, they're micro businesses. And of course, the government is reluctant to change those settings because it impacts on tax take, but it's punitive for small business and a disincentive for them to grow. So you look back, Jeff, it's retrospective, it's biased against risk-taking, it's got a punitive minimum tax rate, there's no income averaging, no smoothing out, and it's a very arbitrary low number, around what a small business is in the Australian context. They're all big fails when it comes to the design of this CGT as it now stands.
Oh, thanks very much, Innes. And just for listeners, we'll now take a short break and be back in a moment to talk about tax reform, other directions it might be taking.
You're listening to the DBrief podcast, brought to you by the Australian Industry Group. To find out more about how Australian Industry Group can help your business, visit australianindustry.group.com.au.
Welcome back to DBrief, where we're talking about tax reform in Australia with Innes Willox, the Chief Executive of the Australian Industry Group. Now, Innes, as you mentioned, one of the things that made these proposals so shocking was the fact that they have come against the run of play in the national tax reform discussion. It's fairly universally acknowledged that Australia's tax system just isn't fit for purpose. Our company and personal income tax rates are some of the highest in the developed world. We rely way too much on inefficient taxes like stamp duty and too little on the efficient taxes like the GST. And for a taxpayer, at every point in the system, you're confronted with this maddening complexity that's arisen from 3 decades of piecemeal changes that have accreted in the tax system like barnacles. But by going down this road in the budget of going after trusts and CGT, the government has kind of sidestepped and ignored all of those systemic problems. So I wanted to ask, particularly after the roundtable you mentioned earlier, what are some of the other tax reform roads and agendas that the government could have taken in the budget, and why have they been put to the side to focus on this CGT stuff?
Well, Jeff, the conversation at the Economic Roundtable on tax was very broad and deep, but made a real point, that our tax system was all interconnected. You couldn't pull apart one part of it in isolation and treat that as tax reform that was going to fix all of our problems. We have problems right across the board when it comes to tax reform. Our tax system is too complex. If you're a national company operating across the Australian landscape, you're paying well over 100 taxes. For instance, it's complex for individual tax payers, who have to go through, hell and back when they're doing deductions and trying to work out their own tax status and what is retrievable and what isn't in a tax sense. And we did have that imbalance between taxing of income and assets that I talked of. So you have to look holistically at our tax system to make the change that you want to make us competitive in a rapidly evolving 21st century landscape. I think what's happened here is that the government got hold of one part of the equation and then, which is capital gains tax, decided to whack a tax on business, shared transactions and the like, and then tried to dress it up as an answer to our housing problem, which was the original part of the conversation around where capital gains tax came out. I don't know where they got lost on that road, but they've got horrendously lost. And they haven't thought through broader tax reform measures that were necessary. And we haven't seen anything from them around changes to individual taxation. Sure, there's what's called the WATO, the Working Australians Tax Offset, which is, basically a government handout, to try to cover up their sins, essentially, when it comes to individual taxation and the lack of movement, particularly on bracket creep, let alone on the rates that individual Australians are paying, which you rightly say is among the highest in the world. We've seen some measures. I talked to them right at the start around instant asset write-off and loss carryback, all welcome, but there's nothing structural around business or corporate tax reform to take us down from being among the highest corporate taxing countries in the OECD. And again, a very complex system, as I mentioned. So, there is a wide open road here for the government to look at tax reform. But again, in this case, they've taken a narrow path but has wide, broad implications for something that we need more than anything else, which is investment, innovation, risk-taking and aspiration when it comes to capital gains tax. The other point I'd make, Jeff, is that as this came from nowhere, in the last couple of weeks, literally before the budget, the last two great sort of periods of reform or change within our tax system, I always say the reform word is thrown around far too loosely, tax changes. In the mid-80s and the sort of late 90s, both came after prolonged periods of public consultation, policy development, negotiation, testing. There was none of that in this case. This was sort of thrown on the table as a take it or leave it. So there hasn't been that policy development that we would come to expect and recognise. Once again, we're dealing with tax policy being made on the run. And that's a pretty sad situation to be. But if the government had looked at those three branches, those three legs of the tax stool, individuals or income tax, corporate and business tax, and that relationship between assets and income, but looked at them holistically, we might have ended up in a longer, slower process, but at the end in a better place.
Thanks, Innes. And I guess the next question, and a lot of people will be thinking about this because as we record this session, this is all very live as we speak, is what happens next? Despite some of the concerns that have been ventilated by a lot of groups, including ourselves, the government appears fairly committed at this stage to most of the proposal. It has decided to hold back the trusts taxation element for a formal consultation, but the rest of the package was introduced into Parliament just in the end of May. It was passed by the House last week, and we're just at the moment doing a very short 2-week review by a Senate committee before it's going to be up for a Senate vote very soon. We have also, for those following the media, seen a bit of mixed messaging from different parts of the government, with different ministers explaining the objectives proposal and what, if any, changes or accommodations might be made around some issues in the margins in different ways over the last month. So I guess the really political question is, how does this play out now? As of today, we're recording on the 9th of June for posterity, but also what would we like to see happen for here, the Australian Industry Group?
Well, Jeff, I think the government is determined as of today to ram through their proposals to get them through the parliament. Now, they obviously have to do negotiation to get that done. They don't control the Senate. They've got them through the House of Representatives, as you mentioned. So the opposition has made clear they will oppose. The Greens have concerns around aspects of the measures. Sometimes in their mind they don't go far enough, but they have a lot of questions. The Senate crossbench, is mixed. You've had Pauline Hanson and Malcolm Roberts from One Nation saying they oppose. Other senators saying different things. David Pocock, very anxious about the way that this is being handled and being pushed through the parliament without sort of proper scrutiny. So it's hard to say exactly how this will end up in a vote. Now, the government wants a very short 2-week Senate process, which involves only 2 days of hearing, which is really, perfunctory, to put it politely. And then there'll be a report to the Senate, and then the Senate will have their debate. What we would like to see is that the government take a breath, stand back, as they have done with trusts, because I think it became very obvious to them on about day 3 after the budget that they really didn't understand what trusts were, what they were used for, how Australians of all types use trusts for income protection, wealth protection, and to ensure assets were passed on to future generations, how they're used in business for that purpose, particularly smaller business. I think they completely misread the public. Anyone who wants to go down and think about protecting assets goes down to their suburban accountant and gets told, we'll set up a trust. That's the best way of doing it. That's just how it's been done. And I think the government completely misread that. And that's why they've delayed that. With the capital gains tax, I think that now they're at the point where, in their mind, it's crash through or crash. And they're very stubborn on this. We have put forward a range of suggestions to the Treasurer, Jim Chalmers, around if you're going to go down this path on the capital gains tax, here's ways that you could address what are real concerns around their impact on innovation, on aspiration, on entrepreneurship is taking in Australia. And they go along the lines of what I mentioned earlier, fixing those anomalies. And that would be, the first position, which, would give the government an out, basically, and not everyone would be happy with it, but it goes to the application of what's being proposed at the moment. The second step would be for the government to step back even further and say, well, hang on, we've not thought this through. We haven't realised the implications, and we'll maybe just apply this to housing in a form which was originally discussed. That was capital gains tax, negative gearing, sort of as a package. And maybe they could go there. Or third is they just step back from everything and say, "Oh, we'll rethink. We'll rethink it. We'll take it off the parliamentary schedule and go back to the drawing board." We would hope that they would take that last course and go back and have another look and do some proper consultation, do some proper thinking, do some proper modelling, do some proper analysis, none of which has happened for these proposals. I think they will push as far as they can and hope for as much as they can, and then politically get the measures through and hope that they get forgotten about, quite frankly. That's hard to see because of the impact that they will have. Businesses, individuals will start to make their arrangements as soon as this legislation is passed. They have a year to make alternate arrangements and to make decisions, and you'll start to see that flow through very quickly, particularly from a business investment sense. And, the government may, if they get their legislation through in the current mind and see the resulting impact, may rethink things again. But look, we're dealing with hard politics here. The government's got everything through the House of Representatives. They now have to negotiate the Senate. You touched on it, Jeff. The hard point here is you can't get a straight story out of the government at the moment around what its purpose is, apart from raising revenue. I think it's sort of been broadly conceded, from the budget papers that the new housing starts are going to decline. The housing impact over the next decade of these changes is minimal. It's not actually a housing package when you analyse it. It's more about grabbing revenue. Well, so Jeff, we hope that the government, through this very short inquiry, sees some common sense and pulls back.
Now, I'd like to end on a bit of a broader issue about what this means for the state of tax reform in Australia. And you've talked about this a lot, Innes, and the roundtable and everything. And this is something that at the Australian Industry Group we've been really active on. In recent months, we've been engaged with the government about company tax, payroll tax, issues of bracket creep, R&D taxes, even tobacco tax issue, which is live, over the last little bit. But the concern is that after these CGT issues and the difficulties the government's had with this, there's a bit of a worry that this, in earnest proper tax reform process might fall at the first hurdle. Irrespective of how the legislation plays out through the Parliament now, which is still live while we're recording, both the policy detail part of the story and the broader politics part you've talked about have been really challenging. And governments of both sides in Australia might look at what's just happened and draw the conclusion, well, this is too hard, never again, right? But with so much tax reform still to do, and you've talked about what we need to do, what lessons could we learn from this experience about how to do tax reform better so we can still digest those big ticket items about bracket creep and company tax and whatnot that are still left on the docket?
Lesson one is, just don't do it like this. Well, this has been diabolical in terms of process, in terms of outcome, and it has, I have to be honest, I think it's diminished business trust and probably public trust in the system, come out of nowhere. As I mentioned, the last two major tranches of tax reform measures came after months, if not years, of public debate and testing, and being tested, in this case of the GST, certainly in the 1998 election, being tested by the public, for the public before it was implemented. Before the budget was handed down, I spent some time with the McKinnon Institute, which is a sort of a non-partisan policy think tank, talking about tax reform. Was led by Mike Baird and Anna Bligh was involved, former state premiers, and we talked about how difficult but how necessary tax reform is in the country to make us competitive, to give us a leg up, to make it a place where businesses wanted to invest and where productivity could be driven forward, using tax reform as one of the many levers that are necessary to do that. But the recognition was it's tough, and we heard from Bill English, the former Treasurer, Finance Minister of New Zealand, who drove through significant tax reform in New Zealand, about how slow the process was, but how necessarily slow it was through consultation, through transparency, through openness. I think we cannot afford for the country to turn its back on tax reform, no matter how hard it is. We've got to this situation where the system is full of barnacles, disincentives, roadblocks for good, for just as they've just accumulated over the years. Our tax system is diabolically complex and is open to interpretation all the time, and it leads to uncertainty. It leads to stifling of investment. It leads to stifling of growth. I think we have to recognise that. So we can't turn our back on tax reform, and we need to continue to try to tackle it, but in a different way. We need to have open, transparent conversations about what problems are, problem identification, and then open, transparent conversations around solutions. And road test those solutions, and to try to then have the public argument so that when tax changes do take place, they take place with, majority public support, but a public understanding that they have been tested. We're dealing with people's hard-earned money here. We're dealing with businesses' hard-earned money here. It's not a plaything. It's not just for revenue. It's essential that we look at tax reform, not just at the federal level, but also at the state level, the interrelationship between federal government and state governments, federal and state systems, when it comes to how the tax cake is split up, but also how the tax cake is made. You mentioned, a whole range of highly inefficient state taxes that need to be looked up. Land tax is the first place you'd start. Payroll tax is another bugbear for business. There are a whole myriad of them that you could look at. So, Jeff, the simple answer is this has been a terribly bad process, a diabolical process, but we can't allow it to discourage us from properly and comprehensively tackling tax reform. It's in the national interest that we do so. It's a huge driver of productivity. It's a huge driver of personal and national prosperity. We sit at the wrong end of the tables internationally when it comes to tax complexity, tax rates, tax levels, breadth of tax. It's ripe for reform. Unfortunately, what's being proposed here will do more damage than good, and it's another piecemeal measure. It's going to take a brave government, and that was one of the big outtakes of what's happened historically in the conversation with Bill English at the McKinnon Institute. It takes a brave government to take on tax reform. They've got to stay the course, got to make the arguments, got to be prepared to make change where they're persuaded to do so. But it's in the national interest that we continue to have conversations around tax reform and we implement tax reform, or else all the things that we're after, productivity, prosperity, investment, competitiveness, growth, employment, they'll all suffer, and we can't afford that to happen.
Thanks, Innes, and thanks to everyone for listening to DBrief. Really hope that this discussion gave you a bit of a better sense, firstly, of what's going on around capital gains, but why, as Innes mentioned there, it's such an important conversation for our economic future. From our part at the Australian Industry Group, we're going to be keeping a very close eye on how this policy debate plays out and through the Parliament. And most importantly, we're going to continue to advocate for business and make sure that this voice you've heard today is front and centre as policymakers work through these issues in the coming weeks and months. Thanks for joining us again, and we'll see you next time. But if you did find this podcast via a link or our website, be reminded that you can subscribe to us on whatever podcast platform you currently use. If you've got any input or comments you'd like to share with us, you can find us on LinkedIn, but we also have an email address, which is industry.policy@australianindustrygroup.com.au, and we'd love to hear from you. My name's Jeff Wilson. I've been speaking with Innes Willox, and thanks very much.
Thank you.